We're here now with Lyn Alden, founder of Lyn Alden Investment Strategy. We'll be talking about macro, Bitcoin, and inflation hedging. Welcome back to the show, Lyn.
Happy to be back. Thanks for having me.
Yeah, great to have you as always. Now, let's start with the macro outlook. Stagflation is a concern for a lot of investors. The notion that we have high inflation and that economic growth is slowing down. In fact, the Atlanta Fed is projecting slower growth in their GDP forecast. So what do you think? Is this a concern for you? Is stagflation a concern for an investor?
Certainly, in rate of change terms, that's something I'm monitoring, and that have basically had a stagflationary outlook since we've entered quarter three. And so, basically, if you look at most types of economic growth, they're still positive but decelerating compared to their peak in quarter two, while inflation has obviously ramped up. And historically, one of the triggers for economic weakness tends to be very, very high energy prices, and we've seen that in the United States to some extent, but then especially we're seeing it in Europe and China, where high input costs can trickle through the rest of the economy and force contractions. We're also seeing supply chain shortages. And so we're in an environment where, if anything, inflation is partially being masked by shortages. So if there's a shortage of something, the price, it doesn't get fully reflected right away. And so basically customers and businesses are dealing with lower quality in their supply chain situation, in their service offerings, while still dealing with pretty high prices.
Okay, and how does that translate to real assets? How does stagflation directly impact, let's say, the stock markets or cryptocurrencies or precious metals?
So stagflationary environment obviously can be somewhat challenging for the stock market. It's also generally rough for the bond market. So right now we're seeing in bonds, for example, that yields are well below their inflation rate. So anyone holding cash or bonds is getting devalued over a period of time. And with stocks, it's kind of hit or miss. Obviously, the financials and the energy sectors are doing pretty well, whereas you've seen some weakness out of some of the more highly valued unprofitable tech stocks. Basically, stock markets have been a mixed bag, especially when you look globally. And so those are the areas where there's certainly risk to the downside. Commodities tend to be some of the best performing assets in stagflationary environments. It's important to realize though that they're volatile, so it's not a straight line. So even if you invested in commodities in the 70s, which obviously did very well, there would have been some wicked drawdowns during that time. And so that's kind of the area that I'm focused on is more that commodity area, more of the value stocks, the real assets, appropriately priced real estate in some markets still. I think there are attractive hard assets out there as part of kind of an overall portfolio mix.
Okay, we'll be talking about inflation hedging in a little bit more detail in just a minute. Backing up, let's talk about your global outlook. I've named one of the risks that investors are watching, stagflation. But generally speaking, Lyn, what are the major factors that might impede growth that you're watching out for? The major risks in the economy, so to speak.
So I think the major risks are these energy shortages that we're seeing, which is kind of the catalyst for stagflation. We also have to see how different central banks start dealing with the fact that they have inflationary environments. And so one of my big themes going into this year was that we probably would get substantial inflation, but yields would still be pretty low, because that's essentially what happens when you have public debt as high as this is, which makes it a very different environment than the 70s. So in the 70s, debt as a percentage of GDP was very low, so they were able to raise interest rates very, very high to counteract inflation. Whereas if you go back to say the 1940s, when you had all that war debt, when they ran into high inflation, they just pinned rates near zero anyway, and pretty much let some of it burn away in inflation. And so I kind of am looking at that situation, but a risk is that if they do try to tighten, which they very well might, that could obviously put some downward force on risk assets across the board, and that goes back to this thing where inflation is rarely a straight line. There are all these pushbacks against it that happen along the way, and so investors have to make sure that they understand their time horizon if they're a trader or an investor.
So you're expecting real interest rates to drop then. If the yields remain low and inflation remains high, isn't that negative for real interest rates and perhaps positive for gold?
So I view real interest rates as likely being negative for a long period of time. Whether or not they go lower than now, I think is hard to say. But I think my key thesis is that they'll be persistently negative, and that there's obviously a certain risk that they go lower. So one of the things we're seeing in the United States, for example, is that shelter inflation is picking up, and so rent inflation and owner's equivalent rent inflation, they have not been large contributors to that initial inflation spike we had, but they're now driving a lot of it. And so they're about a third of that CPI basket. And so that's part of why it's going to be sticky going into 2022. And then, of course, from there, we have to see what happens with the energy cycle, with some of these other demand sources and supply chains.
Just on yields, Lyn, couldn't the government tighten and raise interest rates, but to finance that extra interest expense, they could just issue more currency and print more money?
Well, they can. I mean, basically, that would be quantitative easing while raising interest rates. That's something that we've not really seen central banks try. I think that that's still somewhat of an inflationary impulse when it's combined with that fiscal spending, because basically you're adding currency to the system without extracting it from the system. And so, you know, with the Fed, for example, they've already indicated the order that they want to go in. They want to taper asset purchases, and then they want to be slower to raise rates. And they also, I mean, they have that reverse repo facility that's full, and they have normal repo facilities ready to go should that spill back the other direction. And so they've clearly set a foundation where they want to try to tighten, and yet they still have these buckets to absorb either periods of excess liquidity or insufficient liquidity. And so I think they've designed about as good of a system they can get for at least an attempt at tightening.
At what level of unemployment do you think the Fed would be comfortable in beginning their asset purchase tapering and finally their interest rate hikes? Because as we've seen from their dual mandates, their inflation target has already been more than met, at least for now. Unless Jerome Powell is right in that it's transitory and it'll come back down. So now the question is whether or not the labor market is sufficiently tight to warrant an interest rate hike.
So at Jackson Hole, Powell described some of the conditions. The conditions for their asset purchase tapering are lower, and so they might have already been met. Just judging by the way they're speaking, we'll know more in the next month or two to see if they have a more tangible tapering plan. Whereas their standards for raising interest rates are very, very high. I mean, Jerome Powell referred to essentially maximum employment before they go down that route. Now that can change. I mean, the Fed doesn't always follow its own forecasts over time, especially as you get rotations in who is in charge of those decisions. But overall, I think the long and short of it is that we're probably going to mirror the 1940s in the sense that even if they do raise rates, it'll be kind of like too little, too late. Like if they start putting in 25 basis point raises into interest rates while inflation is 3, 4, 5, 6%, that's not going to do a lot to quell inflation, I think. So they're basically going to be behind the curve, and a lot of it is by design because with debt as high in the system as it is, they don't really have a lot of options.
Okay, and let's talk about inflation hedges then, because inflation is a concern and it's not going away according to many economists. You wrote on your website an article about TIPS, the Treasury Inflation Protection Security. Is that one of the ways we can hedge inflation? Is that the optimal way? Is that not an ideal way? What do you think?
I view it as not being an optimal way, but if you have a mandate to own bonds, or because you're trying to reduce your volatility of your portfolio by owning some bonds, TIPS are kind of like the least bad bonds in this environment. And so the issue with TIPS is that they have lower yields than normal bonds, and actually they have negative yields. And so even though they're indexed to inflation, when you combine it with that negative yield, you're guaranteed to underperform inflation. However, the caveat is that if you get much higher inflation than the treasury market is currently pricing in, then TIPS will do less poorly than normal bonds.
Uh,
And so I do think that, for example, short-term TIPS are a useful allocation, but that there are better volatility, inflation hedges if investors are willing to put up with that higher volatility that they come with.
Now, TIPS, are they indexed to CPI or are they indexed to inflation expectations from the market?
Yeah, they're indexed to headline CPI, and
Okay,
so, but the way that they're priced is obviously that's where we come up with inflation expectations. So
okay.
inflation expectations are based on looking at the yield differential between TIPS and a normal treasury of the same duration.
Explain this phenomenon to me, Lyn. I've graphed this myself. The TIP ETF from iShares, I believe. That price chart has a very, very close correlation to gold. In fact, just taking the last 5 years, for example, the correlation coefficient has been 97% according to my calculations. But however, if you take just the gold price versus the CPI, that correlation is much less strong. In fact, it's rather weak. How do you explain that?
So part of it, I think, is algorithms and financialization. And so gold is basically this investment that we're based on, forward expectations. It has a pretty long kind of duration outlook, you can call it. And so when we look at, say, like short-term inflation, investors don't necessarily rush into gold. Now, I probably would have expected that more would have bought by this point, judging by how high inflation is. But generally the stronger correlation is with those inflation expectations, because that's the same sort of forces that determine how much investors want to allocate to bonds. They basically are looking past kind of like, say, year-long inflationary shocks. Now, obviously, as this has dragged out, people have begun extending their expectations for how long inflation will last. Both the Federal Reserve has changed their narrative to some extent, and investors. So the longer that goes out, those inflation expectations can start to rise. Another kind of complicating factor is that the Federal Reserve is buying both normal treasuries and tips as part of their asset purchases. And so those are not necessarily the most accurate markets to follow. So, for example, if you look at, say, a ratio of the copper to gold ratio, and compared to 10-year yields, that's generally they've been pretty well correlated, kind of lines on a chart, but you'll see a pretty significant divergence ever since the Fed kind of has done this very, very large asset purchases.
Right.
Basically, that chart would have implied higher 10-year treasuries than we're seeing now, but the Federal Reserve took a lot of supply off the market. And so there are a couple challenges with trying to estimate what is the quote unquote the market thinking of in terms of inflation expectations when you have the Fed's thumb on the scale.
Jack Dorsey, he is the founder of Twitter. He recently came out and talked about hyperinflation and the risks of hyperinflation. Now, would you go as far as to say that hyperinflation is going to come and hit the economy in the U.S.?
So not in the near term. That's not my view at all. My base case for a while has been inflation. So higher inflation than we've seen for a while, which is we're in 2021 we've started to see. Now, if you you kind of put your philosophical hat on and think really long term, fiat currencies have historically not lasted very long. This is also the first time in history, the past 50 years, that the entire world's been on a fiat currency standard. And so we are in somewhat of an experiment here. And so I don't think anyone should rule out loss of confidence in currencies. But right now the conditions for hyperinflation are not present in developed countries. And so, for example, if you look at the broad money supply in the United States, it's currently going up by about a 13% annualized rate, which is elevated, but it's by no means what you see in say some of those emerging markets that are having major currency failures. And so I can imagine some scenarios that can lead to a hyperinflationary event. But I think it's premature to talk about hyperinflation with the conditions that we're seeing now or in the near future.
Well, let's talk about non-fiat currencies then. Do you think cryptocurrencies have had a long enough track record to prove them worthy of being an inflation hedge?
So a hedge is a kind of a specific term. Generally, with a hedge, you want it to pay off, not just in terms of direction, but also in terms of timing. So like, it's kind of like, for example, if you have put options on the S&P 500, that can be a hedge. If you're long volatility, that can be a hedge because you have a high expectation that it's going to pay off, within the days and the weeks of the event that you're concerned about. Whereas with Bitcoin, for example, we saw that during shocks in the market, it can diverge significantly from what you'd necessarily expect. And so I wouldn't necessarily call it a hedge in the trading sense, but in terms of, say, a long-term place to put capital, if you are worried about inflation, I think at least Bitcoin has had a long enough track record of functioning well, doing what it's supposed to do, what it's designed to do, and achieving a sufficient network effect. And some of the other cryptocurrencies, I view those more like, say, tech equities, rather than an inflation hedge, where you're basically betting on that centralized development team to deliver kind of the applications that protocol is trying to accomplish. So I have kind of two very different buckets in terms of how I view digital assets.
Okay. Proponents of Bitcoin have called it a store of value. Could you use the term store of value and inflation hedge interchangeably?
I think to some extent. So I mean, you can say, for example, that if you buy oil fields and you buy copper deposits, those are commodities, those are inflation hedges, but you're also trying to store your value against, say, fiat currencies with perpetually negative real interest rates, and currency devaluation and inflation and risks of hyperinflation because you're trying to hold scarce assets, productive assets, things that require real world inputs. And so when we look at Bitcoin, the complicating thing there is that because it's still young, it still has high volatility. store of value becomes kind of a controversial term for it, because generally when the store of value, your mind naturally goes to low volatility. And so the way I describe Bitcoin is that it's an emergent store of value. It's basically a new technology, a new type of money, and it's currently finding its place in the market. So this past kind of, call it 12 years, 13 years, has been Bitcoin rapidly, coming up to whatever market cap it's going to eventually kind of settle towards, or percentage of global asset it's going to settle towards. Whereas gold, for example, is an established store of value. So I think Bitcoin is on track to likely becoming store of value. But basically, you're in the earlier stage of investing in the idea that it's going to go through that S curve and become a store of value. So that I think emergent store of value is probably the closer way to think about it.
The characteristics of Bitcoin you just mentioned, including an emerging store of value and potentially hedging against inflation, those characteristics, can they be applied to the rest of the cryptocurrency market? In other words, would you sell your house right now, Lyn, and buy Shiba Inu?
I would not. No, I would skip that one. I mean, those can be useful speculations for some people, but I'd be very cautious about considering those stores of value. And the main difference is that Bitcoin is kind of achieved sufficient decentralization, meaning that there's not really any party that's able to change its monetary policy, change the how it works. And so we even saw that in 2017, the majority of miners, the majority of large crypto exchanges, the maker of most of the mining equipment, some prior lead developers, they all kind of, teamed up to try to change the way Bitcoin worked in terms of its block size, and basically, have that play out. But they couldn't really get through how the decentralized the node network was. Basically, Bitcoin's kind of designed with that division of powers between developers, miners, and node operators. And so they weren't really able to change it. Whereas some of these other protocols, because they're more centralized, they're able to change. Now, for some, that can be a feature rather than a bug, because if they're trying to achieve a purpose, they can iterate quicker and get, their protocol to do what they want to do. But I don't view those in the same way that I view Bitcoin, which is essentially decentralized money. Whereas those other ones I view more like a tech equity, in the sense that you're betting on the development from like kind of a more centralized team, not necessarily a fully decentralized team, but in some cases a rather decentralized team, and you're kind of betting on that protocol changing over time to meet whatever needs that people want to use it for.
Okay. Now, Bitcoin has breached new all-time highs recently, surpassing its previous all-time high in the spring. Some speculators are saying that, well, it's time for a pullback because that's what Bitcoin typically does when it breaches an all-time high. Others are saying, well, because of the recent momentum, it's too strong to issue a bearish narrative now. So where do you stand?
So overall, we already seen somewhat of a pullback. I mean, it went up to something like 67,000. It came back down to something like 60,000. It's been bouncing around. I don't have a strong view over the next few weeks what it does. Overall, the on-chain indicators generally look pretty bullish at this time. Now that we have Bitcoin ETFs, you have to watch the futures markets as well. It's obviously it's gotten more complex in order to map the kind of intermediate direction for Bitcoin. But overall, I'd say that the bullish case is in my view a lot stronger than the
Right.
bearish case when looking out, say, 6 months.
And I think people have to be somewhat cautious because, yes, a Bitcoin ETF could be a very bullish case, but it's also providing investors another avenue to short Bitcoin, right?
It provides an avenue to short it. It also provides arbitrage, right? Because you
Yeah.
can short the futures and buy the spot, which all else being equal is pretty good for Bitcoin. It also basically makes it so that because those futures are cash settled, you potentially have a rehypothecation issue, which is something gold has faced over the long term. And so there are some advantages and disadvantages. I think the overall advantage is that it showed that the SEC is at least somewhat on board with Bitcoin. We've seen spot Bitcoin ETFs in other markets. The SEC hasn't gotten there yet, but a futures based product, kind of reduces, I think, in investors' mind the perception of a regulatory crackdown in the United States, at least. And we're also seeing more regulations around, banks being able to custody it, banks getting into the space. Basically, it's kind of hitting critical mass in terms of regulatory acceptance, which I think is important for some of the large pools of capital. So even though I personally wouldn't want to own a futures-based Bitcoin ETF, I think there's an important signal there to big allocators.
Okay, finally, I want to ask you about the concept of a Bitcoin or a crypto winter. I've heard this from several analysts I've spoken to. Last time we had a high in 2017, the Bitcoin price corrected by a tremendous margin and then stayed flat for a number of years before regaining its strength earlier last year. Do you think that could happen again this time, next year?
I think it certainly could happen. There are a couple factors that I think are different this time. Because remember, that's a pretty small sample size. Bitcoin's been around for 12, 13 years, and it goes through these 4-year halving cycles. So those winters occurred kind of in the second half of a halving cycle, and so we're talking about a sample size of like 3. And so I think when we extrapolate that out, we have to be aware of a couple differences. One is that as Bitcoin has kind of reached the later stages of its distribution, right? So in those earlier markets, the amount of new supply of Bitcoin was still pretty high, whereas because of those supply flow halvings, almost 19 million Bitcoin already exist, and the other 2 million are the ones still to be distributed. And so those halvings, I think, will matter less and less going forward. We're also seeing that, for those prior cycles, the amount of Bitcoin on exchanges kept increasing. So there were kind of local periods where it would go down a little bit, but generally you had a structural, persistent increase in the amount of Bitcoin on exchanges during both bull and bear markets. Whereas ever since around March 2020, we've seen a pretty persistent drain in Bitcoin from exchanges, and that's kind of partially tied to the fact that we're kind of near the end of its supply distribution. At least in it's going to be distributed out for about 100 years still, but it's asymptotic. So we increasingly get the majority of coin distributed, and so that changes the supply demand constraints. The last thing I'd point out is that because of the way that mining has shifted, so it used to be these small operators, many of them in China, but as we've shifted more towards professional operators, and as we've gone into North America, especially publicly traded companies, a lot of them have better access to capital, so they can issue equity, they can issue loans that are backed by their Bitcoin collateral. There are a lot of institutions in the space that over the past 2 3 years have studied the space. They know how to lend to miners now. They feel comfortable with that risk. They have that specialization, and so because of that better cost of capital, a lot of miners don't ever have to sell their Bitcoin. So we have publicly traded miners where their goal is to mine Bitcoin and then hodl it. And so that somewhat changes also that 4-year supply, halving cycle. And so I think whether or not we get a crypto winter will partially depend on how euphoric it gets in the first place. So in those prior crypto winters, you got extremely high euphoria in Bitcoin and other cryptos. Whereas I think here you've not, by most indicators, you've not seen Bitcoin reach those lofty heights of euphoria that you've seen in prior highs. But if it were to get to a very high level, I do think you'd have a longer cool off period. I just don't know if it would last kind of the same length of time. It really depends on it's more about demand in my view, whereas supply is already getting pretty interesting how tight it is.
All right, excellent. Lyn, I appreciate your thoughts. As always, thank you for coming on.
Thanks for having me.
And thank you for watching Kitco News. Stay tuned for more.